Hello and welcome. I'm Alex Proimos, Head of Institutional Content and Investment Magazine, and this is Market Narratives. This show is a series of unorthodox conversations with thought leaders influencing the world of fiduciary investors. For more related insights and analysis, please remember to check out our website, investmentmagazine.com.au, and subscribe for a free email. And with that, please enjoy this week's episode. My guest today is Rob Doyle, Director of Equity Research at bfinance. Rob, welcome.
Hi, Alex. Thanks for having me.
China is becoming a larger part of the MSCI World Index. Can you give us a bit of a background on how as allocators are sort of building China into their exposure?
Yeah, sure. So, most institutional investors, apparently it's around sort of 70-75%, will get their China exposure through global emerging market or GEM strategies, which, as the name suggests, obviously have the flexibility to allocate across the full spectrum of emerging markets. So among those other 30-odd%, there's a split between those who are achieving China exposure through, regional Asia Pacific equity strategies, those using sort of global all-country strategies that allow emerging markets exposure, and then also those, probably a very small minority who are allocating directly to China itself. So I guess given that the sort of GEM strategies are most prevalent among investors today, if we look at the MSCI Emerging Market Index, the reference benchmark used by pretty much everyone in this space, the sort of headline exposure to China is around 35%. But I guess when we think about active GEM equity strategies, we see very significant divergence in their exposure to China. So I can think of managers who are very structurally underweight at around sort of 5% exposure, then those who will take very, very big positions at sort of 50-60%. So we clearly get these big extremes in terms of how managers think about China. I guess the majority of managers tend to be somewhere like 25 to 35% in the overall exposure. And I guess most often, in my experience, it's common for managers to be sort of underweight this country than overweight. And I mean, there's obviously sort of a myriad of reasons why active managers will take these different positions in China and have different views. And I guess for the majority, it'll be more about the sort of bottom-up opportunity set of China versus broader emerging markets. But I guess at a sort of high level, what we tend to find is those that are sort of overweight are quite growth focused or looking to tap into that Chinese domestic consumption story, whereas those with those sort of significant underweights tend to be those with a sharper focus on things like corporate governance or ESG, where they perhaps can't get quite comfortable with the domestic Chinese market versus others. And I think what's particularly interesting about China, really, and I think it's something that does get overlooked quite often, is there's different ways to invest in China and Chinese companies, and a manager's style and their investment remit can really dictate what type of companies they can invest in. So I guess to kind of give a bit of background here, so very briefly, there's sort of really three types of securities that are most relevant here. So there's A shares, which are the securities listed on mainland domestic Chinese exchanges. You've got H shares, which are securities of Chinese companies that are listed in Hong Kong. And then you've got the ADRs, or American Depository Receipts, which are effectively US listed securities that represent Chinese companies. So between these three types of security, investors can really allocate to China quite differently. Aside from the obvious difference of being listed in different countries, it's really the type of exposure you get from each security that's most interesting. And I think that often drives how active managers position themselves at an underlying level. For example, many sort of consumer, defensive, new energy, healthcare stocks are really only listed on the domestic Shanghai or Shenzhen exchanges, whereas many of the sort of largest, well-known tech firms, the likes of Alibaba, Tencent, Baidu, are listed offshore in Hong Kong or the US. I think market cap is also a relevant point here, because the offshore market is heavily dominated by the large and the mega caps. Whereas the small and the mid-cap companies, with very few exceptions, really are only accessible through the onshore Chinese market. So when we sort of look at China as a bigger piece of the index, I said there's sort of 35% weighting to China in the emerging markets. A shares really represent only a small fraction. That's primarily due to the way in which MSCI has introduced them in a very sort of staggered, gradual way through the use of an inclusion factor. So whether looking at the index level or most GEM equity portfolios, investors would typically have no more than 5% and probably in some cases zero exposure to A shares. I think in part this really reflects in some ways the sort of history and the evolution of the Chinese market, because really until just a few years ago, investors, foreign investors in particular, could not really invest in A shares whatsoever. And even today, really, there are pretty significant restrictions on the percentage of a company that can be held by foreign investors. So, given that A shares, were effectively off limits until just a few years ago, many overseas asset managers really lack that expertise and insight to understand how to invest in this domestic market. And I think what we've seen so far is this sort of baby steps approach, almost, where they're just putting their toe into the market to see how the market behaves and get that understanding. So I think we generally see managers being very underweight to this A share market, and taking very clear steps to kind of build this exposure. Whether that's hiring dedicated, experienced A share analysts, or I guess at a more simple level, just ensuring they've got Mandarin speakers that can interact with companies on the mainland in China, because typically the ability to speak English with these companies is somewhat limited compared to elsewhere. So yeah, really what we see in terms of sort of investors having gem equity strategies for the most part, typically having sort of 25 to 35% to China, but this exposure really being very, very focused, quite narrow, on the offshore markets rather than the domestic market, and really having that sort of clear bias towards the larger mega caps, the names that everybody knows, I guess, the relatively well-covered companies. So I think that's something that investors need to be aware of if they have gem equity strategies, just to understand the type of exposure they've got to China, and perhaps it's not the underlying economic exposure that they might expect. But I think one of the interesting points here, and I guess kind of topical with what's going on in Hong Kong at the moment, when we think about this sort of onshore, offshore difference, whether H shares will continue to be viewed as sort of offshore securities, or whether that becomes more of an onshore play. That's something that I think will be quite interesting to see over the next few months as to how managers treat that exposure and what impact that has.
Mm-hmm. You covered a lot of ground there, and we can start to dig into all those different parts. One of the things I wanted to get back to probably at the top level is that for a lot of asset allocators, they've been looking at China maybe as sort of the implicit allocation to China through their DM, the developed market allocation, or maybe how they can play China around their EM. How do you sort of see that evolving? I know you talked about sort of a specific China allocation, but do you feel that there's still a bit of hesitation around the implementation around China as a allocation?
Yeah, I think the sort of DM point is quite interesting, and I think a lot of investors will take that sort of broad approach to equity investing, and will have, whether it's a global developed strategy or a global sort of all country strategy, which either will have a good dose of sort of Chinese underlying revenue exposure, or actually have some Chinese companies themselves. And I think on the latter, the all country strategies, when they do invest in China, it does tend to be very focused on, again, those very well known offshore names, the Alibabas and Tencents. Even if we look at the ACWI index today, which is, I guess, what most people would use, those two companies alone are sort of 1.5% of the index. So I think we tend to see a clear herding around those names, and perhaps not really getting exposure to sort of a broader piece of China, and just very focused on that tech side. So I think that's what most investors will get with global all country strategies, just that higher level exposure to China rather than the sort of underlying fundamental level. Mm-hmm. I think from a developed market strategy perspective, I think the underlying revenue exposure is probably less than many might expect. It's typically around sort of that 10 to 15% of overall revenue exposure coming from China. So, certainly not insignificant, but perhaps not as large as many might expect. So I think that is something that investors should be aware of. I think what's also interesting, not so much in the past or where we are today, but I guess going forward, I think the sort of Chinese approach now is to move from this more sort of export-driven approach to something focusing on sort of domestic consumption and sort of new wave of companies within China. So there's a potential for it to become a little bit more insular, and companies in China being a bit more focused on the domestic market rather than the export market. So there's a sense perhaps that those sort of higher level strategies, those global strategies, will not be digging into the weeds of the Chinese companies and continuing to play in that sort of offshore market where perhaps that they're not quite as connected to what's going on in the Chinese economy as perhaps some of the smaller than mid caps would be that are based actually in China itself. So yeah, I think it's definitely been a common approach that we've seen from investors, taking that global exposure expecting or hoping there's some underlying implicit China exposure, but I think that is something that's going to evolve potentially over the coming years.
As asset allocators start to sort of dip their toe more directly into China, and you sort of mentioned the particular companies in China, that the domestic ones that are domestically focused, so you can't get that access from DM particularly. As you start to think about the different ways they can access China, you sort of mentioned A shares, H shares, and ADRs. As an investor looks at those three different ways of investing, is there very significant challenges around the legal constructs for each of those different forms of access?
I think this is quite an interesting point, and I think it does make a difference as to how you invest in China and what your manager can do if they have more flexibility. So, in terms of that sort of legal construct, I think this really gives rise to this idea of relative value within China, which is probably not something that we tend to see in other countries, because structurally they kind of don't really allow it. So, within China, it's effectively sort of impossible to directly arbitrage away opportunities that kind of open up between the A share and the H share market. Typically that's due to sort of short selling restrictions or capital controls. So I guess what tends to happen really is the two markets trade pretty heavily out of sync with one another at any given time. So if an investor is looking to build exposure to Chinese banks, for example, they could do this through the onshore securities or offshore securities, and the inefficiencies really between these two markets mean that companies within the same space, ones are listed offshore versus onshore, they can trade at very materially different valuation levels. So really, the investor can look to gain some relative value by investing in the sector via the sort of cheaper route. I think this inefficiency is partly due to those sort of legal constructs that you mentioned. But I think also what kind of drives this relative value opportunity really is kind of sentiment as well. So we see this sentiment is just a huge part of the sort of domestic Chinese market. It's so driven by retail individual investors, as opposed to the offshore market, which tends to be a bit more institutional minded. So we get these huge bubbles in sentiment that really drive this significant disconnect in pricing, where the domestic investors can only invest in the onshore securities rather than the offshore securities. So for those investors who can invest in the different markets and the different securities, they really have the flexibility to kind of capitalize on these sentiment bubbles, not only when they're building, but I guess also when they're sort of bursting as well. But I think that's kind of more at perhaps a sort of a market level or a sector level, perhaps. I think when we look at the individual stock level, there's actually around 100 companies or so that are dual listed in the domestic market and the offshore market. I think we see this elsewhere in the developed markets, for example. It's relatively common to have dual listings, but I think one would reasonably expect these two different securities to trade very closely, sort of, if not perfectly in parallel, given that they are effectively the same company. But actually, in China, they trade completely out of step with each other for the most part. So the sentiment aspect here in China, which I'd say is usually positive. So it means that there's typically a pretty big premium attached to A shares versus the H share counterparts, really. So in other markets, this kind of anomaly would be arbitraged away by shorting, but in China that can't really happen. So you get these discrepancies that just they pop up and they persist for quite a long period of time. There's actually an index that tracks this discrepancy itself, and it's the relative price premium between these companies that are dual listed in A share market versus the H share market, and that currently sits at around 130 to indicate a significant premium on A shares versus H shares, and really that index never really dips below 100 to indicate that the premium on H shares, and even when it does, it tends to bounce back pretty quickly. So it's quite an interesting aspect of China that we don't see elsewhere. I think maybe it's worth saying sort of from a practical implementation standpoint. Most managers that kind of focus their efforts on A shares, they do afford themselves a little bit of flexibility to invest in the H share market. Really because of this disconnect. So this premium or this discrepancy is well known and well understood and accepted. I guess with asset managers being fiduciaries for their clients, they kind of build these strategies to kind of invest in the security they think will deliver the best perceived outcome for the investor. And in many cases that might be H shares versus A shares. So there is that little bit of flexibility. They're not sort of going blind into A shares because they can't invest in H shares. I think that there's a little bit of common sense that has to play into it. So Yeah, I mean, this concept of sort of relative value is well known in the investment markets, but I think it probably takes on a little bit of a different meaning when it comes to long only Chinese equities, and it's probably quite unique, I would say.
Let's just dig into one piece. You talked about the sentiment and retail investors and their impact. How do you think about sort of the evolution of the Chinese market? From an institutional investor standpoint, they're obviously looking to see that the market's sort of stable. Have you seen a stability around sort of correlation around the volatility of the market and the correlation of Chinese securities with US stocks or versus UK or versus Australia? Are you seeing an evolution there that's occurring?
Yeah, absolutely. We are in terms of correlation. So, if we look at the onshore market versus broader gem equities, which I think is what people are thinking about in terms of correlation, perhaps today. I think a lot of people will look at these markets and notice that the correlation on a long-term view is, I'd say, relatively low at sort of 0.5 on a 10-year view. That's definitely increased over the last sort of 3 to 5 years as flows into China have increased and it's become a little bit more internationalized in terms of the investor base. So, this increase in correlation really is not too much of a surprise, and in part is driven by that sort of opening up of the domestic market to overseas investors. So, yeah, it's not as closed off as it definitely once was. So we see this sort of increased coupling with not only gem equities but also developed markets as well. I think the correlation point. We tend to think of these numbers like 0.7, 0.5 as relatively high, which in a correlation standpoint from an absolute perspective they are. But clearly we're talking about long only equities, and global equity markets do tend to follow a pretty similar direction for the most part, albeit sort of moving at a different magnitude and a different pace. But for sort of individual developed markets, we tend to see that correlation of 0.8, 0.9, where they do move sort of in tandem. I guess the key with correlation really here is that we wouldn't expect them to be low in that absolute sense, but I think a number of sort of 0.5, 0.6, 0.7 is actually a reasonable diversifier for a long only equity portfolio. But this correlation point, I think, is something that the people will be thinking about when they look at China versus GEM, and whether there is a benefit to taking that dedicated Chinese exposure from a return standpoint. I guess to me, the rationale really for having a dedicated China allocation within a GEM equity portfolio is not sort of first and foremost about diversification of returns. I think to me, my perspective is that you'd really invest in a dedicated China product to allocate to China in a way that provides the optimal, most efficient exposure to the full opportunity set in the market. So not being limited by whether a manager has that experience or ability to trade in the market and can do so effectively. So this point about how the market is constructed, the domestic market seems to really behave like nothing else in the world, really. And I think more so than anywhere, there is a strong case for having this part of a portfolio managed by a specialist and someone who has been doing it for a long period of time, which, for the most part, gem equity managers have not been able to do this. So I guess to me, diversification, something of a secondary consideration. But like I said, that number like 0.7 is actually a reasonably good level of diversification for a long only equity strategy. But I guess correlation is one thing, and clearly it's something that people think about. But I guess the other aspect is in terms of actual absolute performance, whether these markets are performing similarly or differently. So while the correlations have increased, we've seen pretty wide divergence between the performance of China and not only sort of global emerging markets more broadly, but developed markets as well. Q1 was obviously a pretty stark contrast in terms of performance of China versus other markets. It sort of fell by half of what the broader emerging markets did in Q1. Even if we look year to date, so China's up sort of 20 odd percent, whereas most developed markets, emerging markets are broadly just back to where they started the year. So yeah, this point about correlation, I guess the other point of it really is how sort of onshore Chinese equity market fits within a broader equity portfolio, to your point. So yeah, again, what we've seen really is this sort of coupling of the relationship between developed markets and emerging markets. The last couple of years have been particularly obvious. So the correlation between the MSCI World and the MSCI EM index is around 0.8 now, which is relatively high compared to where it has been in the past. So when you think about it from this perspective, the correlation between China and developed markets is more like 0.6. So there is definitely a diversification benefit to be had by having that dedicated China exposure. And I guess maybe sort of taking this forward, I think we kind of touched on this already, but from this more sort of forward-looking view as to where China is going rather than where the correlations have been, I think it's not necessarily a given that this correlation will increase from here. Sort of trade tensions with the US might be a factor that determines how this progresses. But I guess the bigger part of this really is we sort of know, or are led to believe really, that China is in the process of pivoting its economy to this more domestic approach. And if this does happen and we see this sort of decoupling of, potentially we see a further decoupling of China versus the rest of the world. So yeah, it's not this foregone conclusion that correlations will continue to rise, because there are potential triggers that could send it the other way or keep it roughly where it is.
Are there significant differences between sort of a growth, a value, and a quality sort of perspective? I know you talked about dispersion of returns. How do you think about maybe even merging these different strategies to complement each other?
Yeah, from a style perspective, what we see really is definitely a prevalence of growth-minded investors. I think we tend to see relatively concentrated, growth-tilted portfolios for the most part in the Chinese market. I think value is something that's probably, compared to other markets, is relatively less common. I think the idea really with value investing is you kind of want that security of balance sheet and corporate governance, and something that's going to support the share price over the short, medium, long term. I think the idea of sort of corporate governance in China and that reliability of balance sheet is perhaps less strong than we see in other markets. So there's more of a sort of value trap risk in China. I think managers are quite cognizant of that, and perhaps are less likely to go into those sort of more value opportunities as we probably see them in other markets. So I think there's definitely a prevalence of growth versus value. But I think what we do tend to find really is a focus on quality. I think this idea of corporate governance is probably as important. I guess it's important everywhere, of course, but I think in China it's particularly important. I think we see a heightened level of focus on that from asset managers. So I think you should expect to see managers with a quality sort of bias somewhere in their approach. Whether that's in the way they think about companies or in the actual portfolio they've built. But really, that can be complemented with growth or value quite easily. I think what we've tended to see in terms of sort of combining strategies is perhaps less on the investment style side, but perhaps more on the type of management style. Whether it's fundamental, discretionary versus systematic, quantitative products. And I think again the prevalence really of strategies is in that sort of discretionary space. We see relatively few quant managers out there, and the ones that do tend to be the sort of well-known global asset managers who've sort of applied their sort of well-established quant models into China. But we have seen investors kind of like this idea of combining one systematic strategy, which I guess in theory or in expectation should be sort of more stable in terms of its performance profile, perhaps lower risk, but much more consistent, and then pairing that with a more aggressive sort of growth or value strategy alongside it. So yeah, I think the style complementarity is something that actually is not really taken off quite yet, and I think there's perhaps not that sort of depth of universe of the different styles yet to be able to really do that effectively. I think what we have seen with clients is that interest in pairing sort of systematic, more sort of core perhaps approach with something that's a bit more aggressive, as sort of a satellite position. So yeah, that's something that we have seen.
Is that core piece, okay, you've got given the core sort of the more systematic piece, but then the satellite, is that really a highly concentrated portfolio with sort of 15, 20 stocks? Is that typically how it's approached?
Yeah, I think concentrated obviously is something that will mean different things to different people. I think what we see with China is probably something similar to what we see in emerging markets. So that this sort of level of concentrated, as managers would define it, would be more in the sort of 30 to 50 stock range. So perhaps not concentrated versus a global developed market strategy, but certainly concentrated for an emerging markets portfolio. I don't think we come across any super concentrated strategies, that sort of 15 to 20 level, but I think they do exist. There are managers who are, as I said, sort of, if they're running that sort of 30 to 40 stock portfolio, for example, most of them are quite happy to carve that out and build a higher conviction product on a client by client basis. But I think most people are not at the position yet where they necessarily need or want that super focused allocation to China as they might do in the US, for example, because they might have significant overlapping positions elsewhere in their equity portfolio. I think with China, you're probably getting exposure to some of these companies for the first time, and it's the only part of your portfolio. So I think there's less of a tendency to want these particularly high conviction positions, and I guess wanting something a little bit more diverse, more broad in terms of getting exposure to China. So yeah, it's concentrated relative to emerging markets, but perhaps not relative to developed markets, I would say, in terms of how they're positioned.
So you talked a little bit about sort of the types of managers that you're looking for. Do you have a preference, or is there a bias for allocators in terms of managers that are onshore, actually operating in China, or offshore? Is there quite a distinct difference there?
There's not actually. It's definitely it's an interesting point, and I think it's something that definitely clients have sort of asked us about. Whether they can do this in a relatively low risk manner, so to speak. So I guess looking at it from a sort of performance perspective, whether these local boutique managers based in China, have any sort of information edge or performance edge over the sort of well-known global asset managers that we're all familiar with. I mean, our analysis on this shows that really there's no particular difference in performance between the median local manager versus the median global asset manager. But actually the sort of top performers over most time periods that we've looked at really have actually been those larger firms. So I think, in our view, there's not really any reason why one should be necessarily better than the other. The global asset managers are based in, Hong Kong or on the mainland. So they're as close to these markets as the local players. So there's not really any sort of informational edge. They're familiar with the market. They're experienced investors in their own right. They're not sort of coming from other places and trying to apply what they've done previously to China. So the experience really is comparable for both types of firms. I think what we've tended to see with the work we've done and the manager searches we've done in China is, when sort of push comes to shove at the end of a process, there is sort of a tendency to favor these larger names to sort of minimize that perception of, I guess, operational risk, perhaps. For those sort of setting up seg mandates, which is typically what investors have done through us. I think doing this with a Chinese boutique that you've never heard of, perhaps this will it's likely to require some more thorough operational DD, whereas going with that sort of well-known brand name gives that immediate sense of safety and security, and perhaps that ODD point is much less relevant. So I think, the key really, and what we found so far, is that asset owners can gain access to this market by investing with firms that they already know or work with, maybe on different parts of their portfolio, rather than sort of venturing into this unknown with a manager that they've never come across. I think while this sort of alpha point is relevant and sort of clearly it's been very strong, investors today really should not necessarily expect to see this high level of alpha going forward. I think this speaks to sort of the ongoing institutionalization of China. I think we've seen foreign investors gain a greater prominence here and taking a bigger share of the market. So we should see a more sort of stabilized approach to sort of alpha generation here.
Is there a big difference between the fees on onshore and the offshore, the more global investors, the global managers? Sorry.
Yeah, so there's a couple of different ways to look at this really. So the onshore strategies, I think for the most part, are relatively established. So the local boutiques have been doing this for a while. Clearly, the larger asset managers, for the most part, have been doing this for quite a long time as well. So they're quite established strategies in their own right. Most will have sort of 5+ years track record. So it can command a fee that kind of is based in something in terms of performance delivery. So what we tend to find is the A-share strategies would typically be priced not dissimilarly to global emerging market strategies. So for let's say a 100 million ticket to this asset class, you could expect something in the region of sort of 60 to 75 basis points, depending on the manager, which is very sort of comparable to what we'd see in emerging markets. I think looking at the other types of strategies, so whether it's the pure offshore strategies, which focus really on the H-share market and the ADRs, I think these are the sort of stalwarts in the China landscape. They've been around for a very long time and are very well established, and I think this has become it's a relatively well contested market with a lot of players out there, and I think fees have kind of compressed as a as a result. So typically we'd see those as being somewhat lower in that sort of 50 to 60 mark, perhaps with good negotiation power. I think what's most interesting now on fees is the idea of China all share strategies. I think this is sort of the newer breed of products, which is much less established versus the other two markets, which have been around for a while. So these sort of all shares products, which kind of as the name suggests, really have that flexibility to kind of go anywhere in China, and really sort of opened up as we've seen the A share market become more accessible to overseas investors. So the fact that this is a relatively new asset class with fewer managers and generally shorter track records, we've seen pretty interesting sort of early bird pricing. I think we're still at that stage where investors can command a pretty good deal for these kind of products, and we could see something in the region of sort of 40 to 50 basis points here. And I think while that's kind of based on a newer product that's not established, for the most part, these managers offering all shares products have existing capabilities individually in the onshore and the offshore markets, which are effectively being combined into one. So while you don't have the sort of live evidence of perhaps this all share product, you can clearly point to evidence of how they add value in the underlying markets themselves, and that can give you quite a bit of conviction to invest with these managers. So fees here are particularly attractive at the moment. I would say while we're still at that sort of early bird stage.
Mm-hmm. Now we can't have a conversation about China without ESG, and it's a conversation that many asset owners are always sort of struggling. You sort of touched on a little bit around the governance point of view, but do investors need to sacrifice something in terms of the ESG aspect? How do they sort of blend that piece in when they think about allocating to China?
Yeah. I mean, this is something that we've definitely come across in the work that we've done in China with manager searches. So, I mean, this broader concept of ESG, I think, is less understood in the Chinese market. I think Chinese companies generally have a lesser awareness of ESG investing and what it means to sort of global investors. But I think from what we've seen, that definitely is sort of changing here. So I think the inclusion of the China A shares in the major indices and greater coverage by MSCI, for example, has really brought in this new wave of international investors to the market. And I think many of these will adhere to ESG policies and practices and have certain expectations when it comes to ESG. And I think the companies have kind of taken notice of this approach over the last few years as they've had more dialogue with global investors, and we definitely see them some sort of taking steps here to kind of integrate this in a sensible way. And I think what we've also seen from talking to managers is a growing awareness of ESG investing by companies based on actually efforts by the sort of Chinese government and the regulators there to improve disclosure on company performance around ESG, particularly on the environmental side. So I think we've seen a lot more companies and asset managers talking and being able to access data on environmental issues like pollution when they're looking at companies. So I think while governance clearly is the one area that I think people most associate with China and being most hot on that particular area, I think environmental has become pretty material as well. When we sort of think about the manager universe, I think we have definitely seen a difference between the local boutiques and the global managers as to how they approach ESG and the way that they think about it in China. I think for the global managers, many of these, if not all of them, will have their own sort of firm-wide ESG philosophies and practices and expectations that need to be incorporated. And for them, China is no different to elsewhere. So we've seen that sort of translation of what they're doing elsewhere into China. So typically that does come at sort of a higher level, but also at a more sort of fundamental stock level, and on occasion sort of exclusionary screens. There's obviously some large asset managers out there who will routinely automatically exclude particular sectors from all portfolios, and again that has to apply to China. So things like alcohol and tobacco, might be ruled out from the get-go. So there is sort of that aspect to it. But I think there is definitely a growing acceptance and adoption of the idea that ESG does matter in China, and it can impact both sort of portfolio risk and long-term return. But I guess for the most part, most investors within China are probably at the stage where they're still learning about this concept and understanding how it can be integrated. I think there's probably fewer strategies out there that really have a sort of front and center ESG label where investors can say, whether ESG adds value or not. I think this is probably the problem that investors globally are faced with any asset class really is showing that there's no, certainly no performance cost, but certainly, understanding whether there's any performance give up by thinking about ESG versus not thinking about ESG. And I think, China is probably a little bit behind where other markets are now, and it doesn't quite have that data yet to show that there's no sort of sacrifice that needs to be made in pursuit of being ESG aware or being sustainable. I think one of the key aspects of ESG really is, what we've seen in broader emerging markets as well, really is around the availability of data on ESG and the quality of this data. So I think this, we do still tend to find there are gaps in the data set, which makes it a little bit more difficult to assess. Maybe not the companies as they are today, but perhaps the trajectory they've had in terms of ESG over the last few years, because they're kind of just starting to report ESG data. So we don't know how they're trending and what the sort of evolution is over time. So that's something that is different to other markets, and I think it also makes it somewhat more difficult for the systematic type investors to integrate ESG in a meaningful way, because they're obviously reliant on this ESG data, which does come with its flaws. So I think we have tended to find the stronger ESG candidates tended to be the sort of fundamental bottom up stock pickers who can get out there and do the work and then dig through the weeds and not have to rely necessarily on this data, which doesn't quite cover all the bases. I think again the sort of market cap aspect of this is definitely relevant as well, because we do see this huge variation in the level of ESG information between the different size of companies. So the large cap stocks, the mega caps that typically are based in the offshore markets, tend to have better ESG disclosure than the smaller mid cap companies in China. And I think clearly these companies have larger budgets to allocate to this kind of topic and can commit more resources to it. So we've seen that definitely translated in the way that they think about ESG and communicate about it. And they probably learned more from what global investors are doing and are probably more ahead of the curve than in the sort of domestic market. So I think they've definitely been able to pick up on this trend of what international investors expect and are doing and kind of get ahead of that. But I think we do see this big discrepancy between what the large caps are doing and versus the small and the mid caps.
All right, that's been a fantastic conversation. Thank you very much for your time today, Rob.
Thanks, Alex.
Thank you for joining us. All views expressed on this podcast are subject to change and do not necessarily reflect the views of Conexus Financial. This podcast is for educational purposes only and should not be relied upon as investment advice.